Hey everyone, welcome back to Corporate Decoder. Today, PharmaCyte Biotech Incorporated just filed, and we are looking at some serious financial gymnastics and a cliffhanger on their main product. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is navigating a complex financial landscape with significant investments and changes in how they value their assets, all while their key product is stuck in regulatory limbo. Let's dive into what is really going on. Alright, we're looking at PharmaCyte Biotech's Form 10-K filing, which is their annual report covering their fiscal year up to the 30th of April, 2026. This is the big one, giving us a full picture of their financial health and business operations over the past year. PharmaCyte is all about developing cancer treatments using a special technology called Cell in a Box. They're trying to create a way to deliver cancer, killing drugs more effectively, especially for tough cancers like pancreatic cancer. Here is where things get really interesting. Back in September 2020, they submitted a plan to the FDA, the Food and Drug Administration, to start testing their cancer treatment. But, and this is a big but, the FDA put that plan on hold. They call it a clinical hold, and it means the FDA wants more information and studies before they'll allow human testing to begin. This hold has been in place for years, and it is creating significant delays and uncertainty for the company. The company has been working hard to meet the FDA's demands, completing studies and gathering data. However, getting this hold lifted is crucial, and despite their efforts, it is still an open question. Now, the risk factors section is usually where you find the nitty-gritty. For PharmaCyte, a major risk is that this clinical hold might never be lifted. If that happens, their main development plan for pancreatic cancer is pretty much dead in the water, and that will seriously hurt their business. They're also heavily reliant on a third-party manufacturer, Austrianova, which could cause supply chain problems if that manufacturer runs into trouble. Like many biotech companies, PharmaCyte is burning through cash. They've got limited resources and no approved products yet, so they constantly need to raise money. If they can't get enough funding, their development plans could grind to a halt, and that is a major threat to their long-term survival. This clinical hold is a recurring theme and a huge overhang for the company. It has been going on for years, costing them time and money, and there is no guarantee it will be resolved. Something else that stands out is that PharmaCyte is considered a smaller reporting company and a non-accelerated filer. This means they have less stringent financial reporting requirements compared to larger companies. For example, they don't need their auditor to provide a special report on their internal financial controls. While this can reduce costs, it also means less independent scrutiny on their financial reporting. Speaking of auditors, CBs, PC is their independent auditor. They've audited the company's financial statements and have given them a clean opinion, meaning the financial statements as presented fairly represent the company's financial position. However, they did point out material weaknesses in the company's internal financial controls. These material weaknesses mainly involve a lack of clear separation of duties for the chief financial officer and insufficient management review. Essentially, too much financial power might be concentrated in too few hands, and checks and balances aren't as strong as they should be. The company states they plan to hire more staff to fix this, but for now, it is a sign of internal control issues. Now, let's look at the numbers. As of the 30th of April 2026, PharmaCyte had about $18.6 million in cash and cash equivalents. That is up from about $15.2 million the year before. This increase is largely due to some major financial activities we'll get into. They had about $18.2 million invested in QTC Technologies, Inc., preferred stock, which is a significant chunk of their assets. A big number here is the warrant liability, which is $10 million as of the 30th of April 2026. This represents the value of warrants they've issued that they might have to pay out for, and it is a significant liability. Looking at their income statement, they had no revenue in either 2025 or 2026. That is typical for a pre-revenue biotech company. Their operating expenses were about $6.85 million for 2026, which is a rise from about $4.37 million in 2025. A major factor in the increased expenses for 2026 is an impairment charge of $1.55 million. This means they wrote down the value of an intangible asset likely related to their research and development because it is no longer deemed valuable. This is where things get wild. In 2025, they had over $35 million in other income, primarily due to changes in the fair value of their investments. But in 2026, that flipped dramatically to a massive expense of over $12.5 million in other expenses. This huge swing is mainly driven by how they value their investments in other companies. Like QCLS and PMCs, these fluctuations are very common with financial instruments that depend on market prices. As a result of these huge swings in other income and expenses, their net loss for 2026 was almost $19.5 million, a big change from a net income of over $30 million in 2025. This shows how volatile their financial results are, heavily influenced by non-operational items. Also, note the significant increase in outstanding shares going from about 7.3 million in 2025 to over 8.3 million in 2026. This indicates they've been issuing more stock, which dilutes existing shareholders. The financial statements detail their investments in other companies, QTSE Technologies, which is QCLS and PMCs. These are complex investments where the value can fluctuate wildly. For example, in 2026, the value of their QCLS preferred stock investment dropped by over $8.7 million, while in 2025 it had jumped by over $5 million. Similarly, their warrant assets in QCLS saw losses in 2026 after gains in 2025. Despite the net loss, their cash position actually improved slightly to about $18.6 million at the end of 2026, up from $15.2 million in 2025. This is mainly due to some of those investment settlements and stock issuances we touched on earlier. Management believes they have enough cash to keep operating for at least the next year. However, they explicitly state they will need additional capital to get past the FDA clinical hold, which is a pretty clear signal that more fundraising is on the horizon. A really critical point here is that PharmaCyte is not meeting Nasdaq's minimum stock price requirements. They've been given some extra time until late 2026 to fix this, possibly through a reverse stock split. If they can't get their stock price up, they risk being delisted from Nasdaq, which would make it much harder for investors to trade their shares and could hurt the company's ability to raise money. This is a common pre-bankruptcy pattern for micro-cap companies, where historically about half of companies doing reverse splits end up delisted. They also have preferred stock outstanding, Series C, which has senior rights over common stockholders, including dividend and liquidation preferences. This means common stockholders get paid last and have less say. The company also has the ability to issue more preferred stock, which could further dilute common shareholders. They've got policies in place for ethical conduct and insider trading, but the real story here is the financial uncertainty and the regulatory hurdle with the FDA. So, what is the overall picture? PharmaCyte Biotech is a company with a potentially interesting technology but facing massive challenges. The FDA clinical hold on their main product is a critical bottleneck. Their financial results are extremely volatile due to how they value investments, and they have significant liabilities like warrant agreements. They're also in danger of being delisted from Nasdaq, which is a serious red flag. While they claim to have enough cash for the next year, their future heavily depends on fixing the FDA issue and raising more capital. The risk I am watching is whether they can ever get that FDA hold lifted, and if they will manage to avoid delisting from Nasdaq. What I am actually looking for is a clear path to FDA approval and a stable, sustainable business model, which is currently absent. And the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, and subscribe. Join our Discord for more insights.